Today, let's talk about stonks.
Stonks. That's us. Absolutely.
Specifically, of course, the current adventures in GameStop stock. Stock. Wait.
GameStop stock. There you go. GameStop. Okay. All right. So everything happened so fast and so big, so quickly, there has to be a system involved.
Oh, totally. This is a total feedback loop play. In fact, it starts out as an attempt at a feedback loop play that, from what I've read, and I have not read everything, this is fine, that hedge funds have been playing for a while now, which is you look at a stock and it seems sus. And you're like, I think that one's going to go down.
Is that what the kids are saying these days?
It's also people in Britain. Apparently sus is a normal word in the UK.
But sus means to understand. I need to suss.
No, it means suspicious.
I cannot.
That looks sus to me. If you play Among Us, you'll see.
Okay. It's a deal.
So yes,
all right.
The kids.
A stock looks sus.
Right. And the hedge fund is like, I think that one's going to go down. Watch this. And so they short the stock.
Yeah.
Which means, for the purposes of this, they make a bet that the price is going to go down.
Correct.
And they advertise it.
Yeah, those bastards.
So they take a public short, or at least announce it or put it in their newsletter or whatever. So then we have less confidence in the stock, like public confidence in that stock is decreased, and therefore people sell it.
More confidence, more.
No.
So that has to be reversed.
Yeah, it would have to be.
I thought you were just going to put the price in there.
Let's just
confidence goes down, price goes down.
Okay, so price or increased confidence leads to increased price. But we have lowered the confidence, so the price goes down, which is what they wanted. So that leads to profit on their short.
Yeah.
Profits. But the thing is that, like,
and the circle E, this is a negative connection.
So the feedback loop, I don't know if it causes more people to short it specifically, but the price decreasing causes confidence to go down again.
Yes.
Yeah.
Yes. Okay. But when the price goes down, profit goes up.
The profit from the short goes up. Oh, okay. Right. I don't like this diagram.
Okay. Let's start.
So, yeah, one of the rules of when you don't like your diagram, when it starts bothering you, move it. Okay. So the short we're using to trigger distrust.
Yeah.
Or actually,
yes. Okay.
More specifically, expectation of price decrease.
Okay.
So people start to expect that stock to do worse because the hedge fund bet that it would. Therefore, they probably know what they're doing.
Okay.
And that leads to sell, which...
the more selling, the lower the price.
Lower price. And as the price goes down, that doesn't lead more people to short it. So I'm going to move this up a bit so that I can fit lower price leads to the expectation of lower price.
Right.
People are like, it's going to go down.
Right.
And this feedback loop can go in both directions.
As all reinforcing loops can.
Right. So this is a reinforcing loop. Oh, that I can't, too much black. I can't have everything.
Yeah, thank you.
Okay. That's a reinforcing loop. And the trick is, the amazing thing is that the combination of the lower price and the short leads to profit.
Yeah.
Okay. And that is the magic of the big prestigious hedge fund doing a short and making it public. They both trigger the feedback loop that they then feed off of.
No, wait, they make a rational evaluation of the correct price.
They make a justified evaluation, usually. They make some shit up about how it'll work.
Okay, fair enough. I was trying to take the contrary position and just wasn't.
Oh, okay.
Okay.
Well, I mean, yes, that is the public face, the narrative.
Okay, so as with every reinforcing loop, this can be driven both ways.
Yes. So some people on Reddit decided to try to drive this the other way because they, in fact, did not have an expectation of price decrease.
Right. So they created from whole cloth an expectation of price increase. Wait, go back.
Well, no, they had one. They personally already possessed an I'm just going to duplicate this one.
Okay.
Because I can't stand to. I like it, so I will.
Oh, okay.
Page. All right.
So the way I would notate this is a line going into expectation of price decrease with a circle.
Mm-hmm. All right. So now we're going to get a new color, and we're going to be happy about. Okay. So now we have
with a circle.
Reddit
with artificially, right?
Well, deliberately, but from outside this system. From the hedge fund's perspective, external to the system that the hedge fund was picturing.
Correct.
They started pushing this feedback loop in the opposite direction.
Correct.
Because they really started with this expectation of price increase.
Right.
And so then
caused less selling,
more buying. In fact, more buying.
Correct.
So what they have is so they triggered more buying. Buying led to the price increase, which leads to expectations of increase and back to buying. But interestingly, they made a different feedback loop.
Okay.
So the normal feedback loop would be real expectation of that, but they didn't bother with that. They didn't have to because they got the price increase. They had fun,
mm-hmm.
and then they posted about it, and then they got social status. They got like cred on Reddit. I forget what the points there are called, but they got points.
Mm-hmm. Mm-hmm.
I don't go to Reddit personally.
And they didn't have to buy a house in Greenwich, Connecticut.
Yeah, and then other people saw that they were having fun and they were gaining social status, and that led
to more buying.
To buying Gamestop stock.
Got it. So the right. So this is a very different loop than usual.
Yeah, the part where there lots of different people are buying stock largely for the fun of it. I mean, initially the prices probably was like you could legit argue too low
mm-hmm.
for the company underneath. But then they started having fun with it and it became its own game. And I love this because it completely illustrates you really can't argue that the stock market is about the value of companies.
Yeah.
Sorry, the stock market is about expectations of the future price of that stock.
Yes.
And there are some externalities of the company underneath it. Yeah.
Okay, and the short squeeze. Do you mind if I mean, this is a different system, and it doesn't mm-hmm. operate the way that the system Wall Street expected.
Right.
Knew how to manipulate, knew how to collect from. This is a different loop, and that's everybody's up in arms about that.
Yeah, this is not what the hedge fund peeps expected. So oh, go ahead.
Go ahead. Finish.
Oh, that the existing powers that be have come in and reduced buying of the stock.
Right.
People are talking about they can't use Robinhood to buy the stock anymore. It's been banned, whatever. But then I read something today on Twitter about how one of the reasons Robinhood couldn't keep selling this stock to you is because there's like this capital pool of the more buying that's happening, the more like required capital, especially buying of a large quantity of one volatile stock. When like 30% of your trades are in one stock, you have to start increasing the collateral. It's not capital, it's collateral. That you have to, collateral, close enough. That you have to supply to like the central trading middle person.
Right. So the more required collateral, the less buying, as we saw. Right?
Yeah.
Because,
well, there's a threshold.
Understood, but I'm from a systems perspective, there's now a line from required collateral back to less buying because E-Trade, Robinhood, they all.
But there's a threshold there.
Yes.
Of Robinhood can't raise any more collateral.
Right, they can't.
And so it's not like one of those smooth. Most of these are smooth, continuous kind of effects. This is not. This is I'll raise collateral and keep selling this to you because it's good for my business until I can't.
Yes.
And then you can't buy it at all.
Right.
So it's an all or nothing kind of thing.
So this is an inhibiting loop.
Yes.
Where the more buying there is, eventually the less buying.
Right. Too much buying leads to no buying.
Yes, absolutely. And because it is a threshold.
Right. Which, of course, is even more entertaining.
Yeah, absolutely. Okay, so the short squeeze.
And there was a threshold on the short squeeze, too.
Right. So the higher the price, can we go back to this one? So as price increases, the people who are holding shorts have an incentive to buy.
I'm going to duplicate this again.
Yeah. This one's fun.
Yeah, there's a lot of different
I'm enjoying
here.
It. So the more buying there is, the more the price increases, the more the shorts have to buy.
Oh, yeah. Short sellers have to buy. They have to buy the stock in order to fulfill their short thinger.
Yes, we already have buying there.
Oh, okay.
Price increases lead to buying, which leads to price increases, which leads to buying.
Oh, price increases plus shorts leads to buying.
Yes. Yeah. How do we say that?
The number of shorts influences the amount of buying that results from price increases.
Right. And that's the reinforcing loop.
Yes.
That put a couple of hedge funds on the ropes.
Yes.
Because they had to buy and the more they had to buy, the higher the price went. And
they had so many shorts out that it was more than the number of shares in existence.
Correct.
So they just begged to be screwed, right?
Correct.
They put themselves in a precarious position
because
and then there's a threshold of I can't buy anymore.
Right.
And then
it's a reinforcing loop that they, there's a name for it, a short squeeze. So it happens from time to time, but it happens infrequently enough that they just kind of pretend like it's not going to happen.
Yeah.
And there you have it.
I like babies when it does.
Or try and change the rules. Yeah,
which they probably will. Now, this rule about the required collateral has existed. It does favor the incumbents.
And it's there for good reasons. You don't want brokers going out of business. Because that's
you don't want the central exchange going out of business.
No, this is the brokers have to put up collateral.
Yes.
There were cases
okay.
where brokers would trade in a bunch of stocks, and then the prices would go against them, and then they wouldn't have enough money.
Yeah, there's a whole thing. There's a great thread on Twitter about it. If I think of it, I'll link in the comments.
Yeah.
We don't know, but there's at least this stuff going on. At least this much stuff going on.
And it's a great example of systems. It's a good example of threshold effects where there's a reinforcing loop that mostly you can ignore. And then once in a while, it becomes really important.
You can mostly ignore. Yeah.
Yes. And
the short squeeze has that reinforcing loop.
Mostly ignore it. And then every once in a while, it's going to bite you. And when it bites you, it's going to bite you big.
Yeah.
So.
Yeah, because it only hits that threshold when you go big.
Right. And then it keeps getting worse until you're bankrupt.
Oh, yeah, totally. Yeah. Yeah.
So, systems thinking as applied to GameStop. Thank you, Jess.
Thanks, Ken.
All right.
That was fun. Yeah.
Bye.